Hi, welcome back. In this session, I'd like to follow up on what I started talking about in the last session. If you remember, in the last session, we talked about insiders, looking at insiders buying and insiders selling, and whether they make money from that buying and selling. And the answer is kind of mixed. It looks like they do on average. And whether you can make money using information on insider trading. And there the evidence is much more murky. In this session, I'd like to focus on another group of people that we think of close to insiders, equity research analysts, and look at what they might bring to the table and whether you and I as investors might benefit from what they bring to the table. So let's start by looking at what equity research analysts do. Before I embark on this though, it's worth remembering that equity research analysts fall into two camps. There are buy-side analysts who work for the mutual funds, fund managers, the Fidelities, the State Streets of the world, who do research for their own portfolio managers. We almost never hear about those buy-side analysts. But you also have sell-side analysts who work for the investment banks, and they have high profiles. You see them in the financial press or on CNBC. My focus is going to be on sell-side equity research analysts because they're the only ones who share what they do with the public. So what is the case that you can make that sell-side equity research analysts have an advantage over the rest of us? First, you can argue that they have access to public information, just like the rest of us, but they also have access to the manager of the firm. Now, of course, there are restrictions on what managers can share to them, but that access might give them at least implicit information about what's coming to the firm. Because equity research analysts are sector focused, they follow 15 or 20 companies, you could also argue that they know a great deal more about a sector than you and I do because they spend their entire lives following big box retailers or following semiconductor chip companies, that they're sector specialists. They do have the data that the rest of us do, but they probably have better data access because their employers can pay the thousands of dollars to get a FactSet or a Capital IQ or any other data to them, and perhaps more expensive tools they can use to assess the data. So maybe they can use that to make better forecasts of earnings. And as we will see, that's a big part of what sell-side equity research analysts do. And revising those earnings. And finally, sell-side equity research analysts make buy or sell recommendations on companies. They pass these recommendations to their clients, and their clients can act on them. And to the extent that their clients listen to these analysts and act on them, it's entirely possible that when a sell-side analyst makes a buy recommendation, clients buy based on that, and that can push up the price. There's a price effect. With sell recommendations, the opposite happens. So there's an argument to be made that sell-side equity research analysts do have advantages and should show up in what they do. Now, before we look at what equity research analysts do and whether there's money to be made from looking at what they do, it's worth also remembering where these sell-side equity research analysts congregate. What I have in this graph from 2025 is I've classified companies based on market cap for US companies from smallest to largest. Bottom decile are the smallest companies, the top decile are the largest companies. You can already see that the number of analysts is far greater with the larger companies, about 28 analysts on average, whereas with the smallest companies, the average is 0.60. In fact, only 6.5% of the smallest companies have sell-side equity research analysts tracking them. The remaining 96% plus have no analysts tracking them. Whereas when you look at the largest market cap companies, close to 81% of them have equity research analysts tracking them. So if you look at who companies follow, three things that seem to drive it. One is market cap. Larger companies are more likely to be followed by equity research analysts than smaller companies. Second is institutional holding. The greater the percent of stock held by institutions, the more likely it is to be followed by analysts. And the reason is very simple. As I said, sell-side equity research analysts do research for clients. They don't get paid for the research. The clients have to do business with the banks that the analysts work at to make money on this research. That's more likely to happen with institutions and individuals. So the larger the institutional holding in a company, the greater the likelihood it's going to be tracked by analysts. And finally, trading volume matters. More liquid stocks, where there's more trading volume, are more likely to be tracked by analysts than less liquid stocks. Larger companies, more institutional holding, higher trading volume all lead to more equity research following the company and much more output from that equity research. So let's focus a little bit on what sell-side equity research analysts do. In addition to doing all their research, one of the key things that you get out of sell-side equity research analysts is forecasts of earnings per share, often for the next quarter or the next year. And they constantly update these forecasts. I will wager that a significant amount of time that sell-side equity research analysts do on research goes into these earnings forecasts. Now, if you look at those earnings forecasts itself and look at what information they carry, first, to the extent that sell-side analysts are getting information from the firm that is not available to the rest of the public, and I'll have to put quotes on that information because in the US at least, technically that shouldn't happen. But there's other ways of conveying information. That information can go into the forecast. Analysts can also look at macroeconomic developments. Is the economy getting stronger or weaker? If it's getting stronger, maybe a forecast for retail companies and cyclical companies will improve. It could also be information that analysts get by looking at comparators. When one automobile company reports better than expected earnings, you as the equity research analyst might increase your forecast for other automobile companies as well. There can also be private information about the firm that doesn't come from the firm itself, but that analysts themselves collect through a variety of sources. And finally, there is a whole host of public information out there that can go into their forecast. The bottom line is when analysts forecast earnings, they should do much better than somebody who just uses historical earnings and makes a forecast for the next period. In other words, a time series model. There have been studies that have looked at how well sell-side equity research analysts' earnings forecasts measure up. And the results are actually surprisingly modest. The good news is, on average, sell-side analysts' forecasts are better than time series model forecasts. How do we measure better or worse? You look at the forecast error, what the forecasts are relative to actual. If you have perfect forecasts, the forecast error is 0. Nobody has 0 forecast errors. And on average, that forecast error is lower for analysts than from time series models. That's good, right? But not by much. One study found, for instance, that the average forecast error when you use time series models is about 32%, and the analyst forecast error is about 28%. That's a surprisingly small drop-off given how much time, money, and resources we spend forecasting earnings. In fact, when you look at these time series models, even on a quarter-to-quarter basis, time series models actually outperform analyst forecasts from April through August and then underperform them from September through January. Read into it whatever you want about second quarter, third quarter, where the advantage for analysts comes from. And much of the forecast accuracy of analysts comes in the near term. In other words, 1 quarter ahead forecast, you have a shot of using analyst forecasts and doing better than time series. You make that 1 year ahead, the improvement drops off. And when you go to the long term, that becomes, and as we'll see, almost impossible to find a forecast error improvement. If you look at the forecast errors over time, and this is from a fairly old study, it needs updating, you find that the forecast errors that analysts make about earnings seem to be a function of how well the economy is doing. And this might not surprise you. When the economy is doing better than expected, that's what the industrial production captures, the forecast error seems to be negative. In other words, analysts underestimate earnings. When the economy is doing worse than expected, analysts overestimate earnings. Maybe the macroeconomic component is not finding its way into the forecast as much as it should. So let's summarize. With short-term forecasts, on average, analyst forecast errors are smaller than time series models, but the savings are modest. And even with 1 quarter ahead of forecast, they're a function of the time you're in, what the economy is doing. Now, we look at long-term forecasts. Analysts sometimes forecast 5-year earnings. And there's a story there I'll come back to. When you look at these longer-term forecasts, the results are much more mixed. Some studies find no improvement. In fact, one study, in a very early study, concluded that analysts were not great long-term forecasters. A much later study said there's some improvement, but it's not that much. But here's the most telling detail. If you have a large market cap company tracked by 35 or 40 or 50 analysts, not all of them make 5-year forecasts. In fact, 60 to 70% of analysts skip that step. They stay with 1 quarter ahead and 1 year ahead. telling you something about what they think about their capacity to forecast longer term growth. So that's a big component, is forecasting earnings. In the next session, we'll talk about what happened when the actual earnings come out. But analysts also revisit their forecasts. So they make their forecast of next quarter earnings, and then they'll revisit it a week or 2 weeks, 3 weeks later, and they make revisions to those earnings. And there seems to be some information in what kind of revisions you can make. Let's break it down. Analysts can revisit an earnings forecast and either revise it up because they got good news in those 3 weeks, or revise it down. When analysts revise earnings up, there seems to be excess return. Stock prices tend to go up in the months after positive revisions. And when you look at, comparing, the most extreme revisions have the biggest, and this should come as no surprise, biggest stock price effect. But here again, there's some fuzziness in the findings. Much of the excess return is concentrated in the weeks around the revision, right? In fact, the one study found that prices before positive revisions were actually negative in the week before and positive in the week after, and that some analysts have a much bigger impact. We'll categorize them as leaders because of the number of people who track them, and we'll talk later about who goes into that leader pack, have a much greater impact. So earnings forecasts are out there. Revisions of those earnings seem to have information. But I think there's a pitfall in using analyst earnings forecasts as your basis for investing. After all, analyst forecast earnings rest on the two weakest links in this process. One is earnings coming out from companies which are subject to accounting gaming, and analyst forecasts which are biased. Much of the analyst impact comes from having clients who will trade based on those, based on the earnings forecasts. And the more influential an analyst becomes, the greater the client effect is. In fact, as an aside, sell-side equity research analysts have their own special club, a club for the very best of them. It's called an All-America team of analysts. And you'd think the All-America team of analysts would include the analysts who are best at forecasting. It's not. It doesn't. It actually includes the analysts who have the biggest client base, who have the biggest influence, who have the biggest megaphone out there. Much of what you can make based on analyst forecasts is short term. Even those revisions I talked about, short term, and the returns we're talking about are not 50 or 100%, they're 1% or 2%. Put simply, you're not going to get rich of analyst forecasts, but you might get a little richer. And finally, it does seem to matter who the analysts are, that some sell-side analysts have such a low profile and so few clients that they don't affect prices. Maybe the entire analyst effect comes from that client effect, that they have clients following their advice. So that's earnings forecast, their pluses and minuses. There's some information there. But analysts also put out recommendations. Generally speaking, you can think of these recommendations falling into three parts. There are buy recommendations, there are sell recommendations, and there are hold recommendations. But analysts actually go a little further. They have gradations: strong buy, weak buy, hold, weak sell, strong sell. So if we break these stocks down on these 5 groupings in 2025, here's what the recommendations look like. Buy recommendations vastly outnumber sell recommendations. This has always been true. People have talked about it. It doesn't go away. Some of it might come from the bias in the process. You're a sell-side analyst and you track 15 companies. You need to maintain good relations with that company. And if you put a sell recommendation, you might burn your bridges. That company might never talk to you. So this process is skewed towards buy versus sell, and everybody knows that. And the strong buy, weak buy, strong sell, weak sell becomes an implicit way an equity research analyst can ask you to sell. A lowering of a company from strong buy to weak buy is actually a sell, without saying the word sell. So these recommendations are made by companies, and presumably people look at them and they act on them. And if you look at stock prices around these recommendations, and this is from a study again that's dated, I haven't found an updated version of the study, can talk about something. This is what happens to stock prices on the day of the recommendation, 1 month after, 3 months after, and 6 months after. So when a stock is added to a buy, there is a jump on the stock price for about 3.5%. If you track it 1 month after, it's about 8%. 2 months after, it's about 7.5%. But if you track it 6 months later, it's back down to about 2.5%. You're saying, what does that mean? There's an immediate impact from the recommendation. It builds on itself. There's a drift after the recommendation, but if you track it long enough, much of the boost you get from the recommendation seems to fade away. When a stock is removed from a buy, maybe from a buy to a hold or a strong buy to a weak buy, the initial effect is negative. 1 month later, it's less negative. 3 months later, it's slightly more negative, but 6 months later, it's much more negative. Negative recommendations seem to have much more staying power. And you see that even with the added to sell, much more staying power, because 6 months after, the stock is down much more than it was in the initial day. But if you look at buys removed from sells, the effect is much fuzzier. There's an initial positive, but by the time you get to 6 months later, the overall effect is all of these, we're talking about small changes in the price. There is an effect that recommendations have that's consistent with the recommendations. Buys, the stock price goes up. Sells, stock price goes down. But there are questions about how much it goes up and how much staying power that has. So recommendations have an effect, but in many cases, that effect fades over time. There's one more caveat to add about equity research analyst recommendations. Equity research analysts often work for investment banks, and investment banks often have other business that they do with the companies that these sell-side equity research analysts track. It creates a conflict of interest, right? So one study actually looked at recommendations made by sell-side analysts who have no other investment banking business, in this case underwriting business, and sell-side equity research analysts where their investment banks had banking business with. And this shouldn't perhaps come as a surprise, but it turns out that by recommendations by analysts who have other business with a company have much less staying power. So maybe when you look at a sell-side analyst recommendation, you also check out whether the investment bank they work for has other business with the company being tracked. So if you decide to go this route of using analyst recommendations, can you make money over recommendations? In the near term, the answer seems to be yes, but only if you jump in before the recommendation comes out. I'm not sure how you get that. Maybe there's a select group of clients that analysts release these recommendations if you're in that select group. But if you wait for the recommendation to come out, the price jump has already happened. I'm not sure there's much money to be made. If you decide to take this route of looking at sell-side analysts and incorporating what they do into the process, here's my suggestion on things you should do. First, look for the analysts who have the biggest impact, the most following, because that price impact matters. Screen out analysts who have conflicts of interest. We talked about the conflicts of interest of banking business. If you invest based on the recommendations, go ahead, but remember you need to get out at the right time because some of the buzz that you get from the recommendation fades over time. And also watch the analysts for those very subtle signals that they might let out because remember we talked about how they try to tell you to sell without ever using the word sell. Strong buy to weak buy. Watch out for those signals because those signals will have a price effect as well. So I don't use analyst recommendations in my investing, but if you can find a way to incorporate into your investment philosophy, all the more power to you. In doing all of this, though, there are some things to recognize about the entire business world, the market that we live in. First is the advantages that equity research analysts have over the rest of us has shrunk dramatically. Part of it is new rules and insider information, making it more difficult for companies, at least in Europe and the US, to share the data just with analysts. There might be some emerging markets where you still can get insider information as an analyst. Access to public data has been much more democratic. I can get the same filings and data that a Goldman Sachs analyst can, and that wasn't true 30 years ago. And the tools that these analysts use, you and I can have access to them. Whether it's Excel or Python, we can build our own tools that can match up to them. So the analyst advantages have shrunk. And it's worth remembering that analysts don't play the investing game. Your job as a sell-side analyst, when you ask me to buy a stock is you're not telling me the stock is cheap. You're just telling me it's cheaper than the other 15 companies you track. You tell me to sell, it's more expensive. You play the pricing game, not the investing game. And I've got to factor that in when I look at your recommendation. So when you put a buy recommendation on an AI stock, all you might be saying is this is the least overpriced AI stock out there, not that it's an underpriced AI stock. So the game is evened out. The analyst recommendations have a lesser impact today than they did. And people often act on these recommendations, right? Maybe there's a different game you can play where you can assume that these price reactions are overwrought. So when an analyst puts a buy and the stock jumps 10%, you assume that that 10% is going to fade. You sell short that stock. Conversely, if the stock drops 20% because there's a sell recommendation, you go buy the stock. You're playing against the analyst here because you think the clients are being led down the garden path. I hope you found this session useful, and I thank you very much for listening.